Welcome back. Well, for a look at some important stories in the world of business this morning, let's head to Bloomberg's Divya Balji. She's managing editor, Breaking News Americas, and she's in the Bloomberg News Bureau in downtown Toronto. Divya, thanks as always for joining us this morning. Macy's, a big story here. The company has reportedly received a takeover offer. The stock is soaring in pre-market.
That's right, Paul. I mean, $5.8 billion is what we're hearing is the buyout offer from a group of investors, really. You know, I think in this case, when you look at it, some people are looking at it from the perspective of if they are taken private, it is possible that you can run the business at a better pace and actually turn things around for this company. Now, this is also a company where the CEO has actually announced his retirement. They will be going into retirement in February. A new CEO has been announced. Perhaps this is the right time to make something like this happen. You know, as we know, retailers have struggled quite a bit this year with higher interest rates. People aren't spending as much as they normally would on discretionary goods, and that's certainly hurting Macy's. So perhaps this might be a good time to change things around, take it away from being a public company. We are still waiting to hear from the company itself and from the investor group to see what's going on. There's still a lot that could happen, but overall the market is quite excited by the news. It jumped as much as 22%, the shares of Macy's, climbing over that offer price of possibly being $21 per share. So for now, the market seems quite excited about that deal.
Interesting. Okay. There's also M&A news of a different sort in the health insurance sector. Cigna is walking away from talks with Humana. That looked like it was going to be a huge combination.
That's right. It was supposed to have taken this merged company to a market value of $135 billion. Now it sounds like the deal may not be happening. It sounds like the offer Cigna is willing to put in and what Humana was hoping to get out of this, they're quite far apart. Some of this might have to do with the fact that Cigna's shares have dropped a decent amount recently, down almost 10%. I think since we first heard about this, that could be impacting the deal as well. You know, Cigna did put out a statement on Sunday talking about how they plan on doing more share buybacks because of the sell-off in its shares, but they did not talk about this possibility of this deal going sour or this deal getting terminated. So there, again, it's similar to Macy's where we're still waiting to find out more. You know, if the stock does surge again, could that possibly change the course of the deal? You know, it's really hard to tell at this point, but it's another one that's a deal in action that I'm sure a lot of traders out there are paying a lot of attention to right now.
Let's finish with a company called ByteDance. It, of course, is the parent of TikTok. What's going on there?
Yeah, so they have basically bought into a joint venture with an Indonesian e-commerce company. Their e-commerce outlet is called GoTo. They're buying about a 75% stake in this. That's about a $1.5 billion value, or that's what they're paying. So they're going to be owning a majority ownership of this. They're going to take control of this online retailer. It's probably good news for TikTok considering how big of a space that is in Indonesia. It's a very huge population. A lot of retail happens online. But on the flip side, you know, not so great news for two other companies that are in that same space, Alibaba being one of them that is already struggling with Temu that has come into the play. And then there's also Sea Limited, which is a Chinese company but is based in Singapore that did actually take a huge market share when it first started in this entire space. But now its stock is hurting because of this new joint venture deal that has come through. You know, so just not a great day for other Asian e-commerce companies right now, but quite a significant deal for TikTok and for GoTo, the Indonesian online retailer.
Divya, thanks a lot, as always. Divya Balji from the Bloomberg News Bureau in downtown Toronto.
It's been quite the year in metals. We saw a whole bunch of takeovers, especially in gold. Newmont, Newcrest springs to mind. We did see bullion hitting a fresh record in the cash market just a couple of weeks ago. And metals used for EV batteries have plunged. Lithium, cobalt, nickel, all under pressure. We got analysis and an outlook for 2024 from Colin Hamilton, a metals analyst, commodities analyst at BMO Capital Markets.
We look at industrial metals demand this year. It's been up in China pretty consistently, and that's despite the weakness and the much discussed weakness in the property market. It's been the rest of the world where you've got interest rate sensitive consumers that have really struggled here. So for metals, actually, China's been a net positive delta again this year. We've seen strong fiscal support coming through incrementally from the Chinese government. Now, as you say, sentiment's been weak. I would say peak pessimism around China, though, was around June, July, and we've seen steady improvement from that point forward.
That is a fresh theme, certainly one I haven't heard. You were forecasting a slight copper surplus for next year, but now Cobre Panama, the fiasco there, is inclining you to think that there may be a deficit in 2024 in copper.
That's correct. And if we think back to the start of the year, we had a lot of disruptions in copper. Then it all went a bit quiet. And actually, Q2, Q3, we're seeing strong supply growth. Supply disruptions have come back with a bang. Not only Cobre Panama, which of course now we have to really take out the model basically for much of 24, but also we've seen maiden guidance come through from a lot of the other miners. Anglo American on Friday was a prime example. 200,000 tons of copper lower than we had previously expected, and for Gasta, various others. So with that, the mine supply side is a problem in the copper market. Plus, as I said, China demand looks okay. I'm expecting reasonable China grid spending. And with that, we're looking at a much tighter raw material market. Now, 2024 was meant to be the bad year for copper. It's not looking like a bad year anymore.
On mining capex, you say that boards are becoming far more demanding when management come in with aggressive spending plans, and you say that it's likely that capex could trend lower again in the industry, mining capex.
I think on a like-for-like basis, potentially. Obviously, we have some inflationary pressures, which might boost up the absolute value. But when you have situations like if we go back to another one this year, QB2, big capital overrun. So boards are just cautious. We're still in an environment where labour's tight, really maybe not the same trust in economics that there was in the past when they're presented to them. And they just want that higher hurdle rate for return, particularly when equity markets are still rewarding them for keeping the balance sheet in check and returning money to shareholders. So I don't think that thesis really changes in 2024, particularly given, if you want, sentiment towards some other areas like the energy transition is maybe down a bit from where it was earlier in the year.
That's interesting. Maybe they'll even emulate the oil industry, or maybe they have been, the oil industry holding back on capex and just paying out dividends and buying back stock. We know that it's been a disappointing year for some of these so-called energy metals. Part of that is a supply surge. But it is interesting. You say constraints on renewable energy are emerging, including grid bottlenecks. I mean, we need to rebuild the entire electric grid if we're going to go all electric.
That's correct. And I mean, the key thing here is solar panels. We've seen, of course, a big push towards security of energy supply across countries across the world over the past couple of years given everything that's happened in geopolitics. And with that, you've got a lot of solar panels that are generating at the middle of the day, pumping into a grid which is not it just can't cope with it. So we've actually got several provinces in China now who are saying, look, we can't keep up the pace of installation because our grid cannot cope. So what does that mean? It means some grid investment next year. I think you will see a big push for utility grid spend, but it also means solar panel production probably has to slow down a bit. That's been a big help to, for example, aluminium demand this year. Maybe that tailwind might not be there for 2024.
Well, the U.S. Federal Reserve is expected to hold interest rates steady for a third straight meeting. Of course, rates are already sitting at a 22-year high. That has prompted questions about how long that will be warranted if we do see signs of inflation easing. Here in Canada, some have argued the stakes surrounding higher interest rates are higher as we have seen more signs of a cooling economy, and there are growing expectations rates will come down next year. Back to the Fed. There could be some pushback against the market's growing belief that U.S. cuts are coming soon. Note the growing belief that we've seen in the market, as we were just discussing with Ed Yardeni, has helped to lift riskier assets in recent weeks. But for the Fed Chair Jay Powell, he has previously emphasized the desire to evaluate the impact of higher borrowing costs before signaling any cuts. That Fed decision coming at 2 Eastern time today. There will be a press conference with Powell, so lots of messaging to chew on. Let's bring in Carl Riccadonna, who is chief U.S. economist at BNP Paribas, for his perspective. Carl, it's great to see you. What do you think the overall message here from Jay Powell and the Fed will be?
Well, I think consistent with what your prior guest was highlighting. In November, we heard from Chair Powell that he felt increasingly confident that the Fed had done enough in terms of raising rates. And so now the question pivots to the duration at this high and restrictive level. Market is starting to eye the possibility of cuts, and there was some Fed speak before the December meeting that suggested maybe the Fed could be moving earlier than market participants were anticipating. Fed Governor Christopher Waller suggested it could be 3, 4, or 5 months, which clearly puts March in play for Fed action. I don't think that Chair Powell is happy with the everything rally that has taken off since the November meeting. And so that pretty significant easing of financial conditions, I think, does factor into the Fed messaging from here on forward. So I had the markets not moved the way they had in recent weeks, I think the Fed could have moved towards a more neutral, balanced assessment of the economy and of the policy outlook. But we can't take that in a vacuum because there has been this dramatic easing of financial conditions. So I think instead, the Fed is going to leave some hawkish elements on the table, both in terms of their formal meeting statement, but also even more so in the press conference following the meeting.
What will be the ultimate determining factor as to whether or not there's an actual move lower with interest rates? Like once we get through this period of messaging to try to control what's happening in the actual markets, what does the time frame look like for you in 2024?
Sure. I could see the timeline being at some point in the first half of the year, not as early as that March meeting. I think that's a little bit too soon unless we see some more evidence of a hard landing for the economy, something Ed was making a compelling case against. And I tend to agree that hard landing is not the direction we're heading. That being said, we don't know what the landing will look like until the wheels touch the runway. And I'm a little bit less optimistic this will be a smooth Goldilocks landing. I think some problems could arise, and I think that pushes the Fed into action probably in the second quarter of the year. My base case is at the May meeting. I think there is some, while the Fed doesn't like to admit it, there is some political pressure to do whatever they need to do, or at least start the process outside of close proximity to the U.S. elections. So I think that is a swing factor next year that kind of forces them to, by June or July at the latest, they have to be underway on whatever the policy plan is going to be. So base case, I would say May. And there's kind of two paths that get us there. One is the smoother landing, the inflation moderation path, which I think will continue. But even as we saw yesterday in the CPI numbers, this is not an easy glide path back to 2% inflation. The first parts of that glide path were easy, but the last few miles, I think, are going to be difficult to achieve that pace. Put another way, the inflation numbers looked very 2-ish over the last couple of months. I think it will look more consistent with a 3% run rate over the next couple of months. And the harder landing path then is more of a destabilization in the economy, the labor market falling apart to a greater degree. I'm not seeing evidence of that, but that would get us to faster cuts.
And I do want to circle back on what you said about political pressure, because we've been watching that story play out in this country as well, whether it's provincial leaders and their message to the Bank of Canada, or even some of the commentary that we've seen from our finance minister. Today, the Treasury Secretary, Janet Yellen, said in an interview that it would make sense for the Fed to consider lowering interest rates as inflation eases to keep the economy on even keel. So is that the kind of thing you're referencing when it comes to sort of heading into next year, especially with the election coming, that this is going to get attention?
I think the Fed wants to avoid the perception that they're taking action, a month out or so from the election and potentially causing a big market reaction that would maybe factor into voters' thinking. Of course, the Fed is going to aim to do what's right. So they try to be apolitical. But when you know there's a big political event coming, then maybe you try to give a little extra berth to maybe act a little sooner, or just be clear that you're not waiting unnecessarily into kind of key political developments. But the inflation numbers are improving, and the Fed can probably recalibrate their policy stance in response to those lower inflation numbers. I am, pardon me, I'm still a little skeptical that we'll see the improvement in the categories we need to. in terms of labor inflation, wage costs, the rent story, and of course service inflation outside of the shelter story. We're seeing more evidence lately that it's not going to be as easy as a lot of forecasters had anticipated, and that may push the Fed to resist the urge to cut rates for a meeting or two at the margin.
Okay, so we'll keep watching. A lot to continue to unfold here. Carl, thanks very much. Carl Riccadonna with his take.
Well, for more on the markets, let's bring in Mike Archbald, Vice President and Portfolio Manager at AGF Investments. Mike, thanks so much for joining us this afternoon.
Good afternoon. Thanks for having me.
So what do you make of the Fed's commentary from yesterday? I know it's already been 24 hours since then, but it still is top of mind for many in terms of, understanding what this shift in commentary could mean for broader markets.
Yeah, I mean, certainly we saw the, I guess they're calling it the Powell pivot. And, this was a fairly significant change to monetary policy. I think one of the most significant ones we've seen certainly in his tenure in the last decade or so. So the Fed, really acknowledged that interest rate cuts are coming. The market had that price. They had about 4 priced, and the Fed's telling you it's likely going to be 3. And as you mentioned, the market's now got about 6 in there. So we kind of have the goalposts here between 3 and 6. I think, what's happened is that you've obviously seen a big move to risk on. You're starting to see different sectors perform well, and you mentioned some of them. Financials and REITs would be the two that come to mind here. But I think what is really important is just that he talked about wanting to reduce their policy rates ahead of inflation hitting their 2% target. So as opposed to being a headwind for growth, the Fed looks like it actually is going to be a tailwind for growth. So I think given the amount of money that's sitting on the sidelines in money market funds and high interest savings accounts, you have a pretty good backstop now with the Fed going to be cutting rates at some point in time next year. And I think that's going to be, a buy the dip type market here.
A buy the dip. So perhaps not taking action right now then, because things aren't dipping at the moment. Would you be sort of poised to take action when an opportunity came up?
Certainly. I mean, I was adding a little bit yesterday into select sectors and stocks, but definitely the market is very overbought here. It's been overbought for weeks, and so a period of consolidation could certainly take hold here. But as I mentioned last time I was on, I think we're probably poised to hit all-time highs. I said Q1, and maybe it's going to happen before that. But with the Fed cutting rates or talking about cutting rates, this is likely to result in financial conditions remaining fairly easy. The spending data that you saw this morning and the employment figures are still quite solid. And so this is going to result in higher valuation multiples. So I think you're going to want to see, investors continue to put capital to work here. As you mentioned in the intro, I think a couple of things have been happening in the last few days. The economically and interest rate sensitive sectors have taken a lot of, the share of the wall the last couple of days. And you're seeing names like Dollarama, Couche-Tard, Loblaws, as you mentioned, having their biggest one-day declines today. And that's, I think, a little bit of profit-taking in some of the year-to-date winners. You're seeing that in some of the insurance names, the engineering and construction companies. So all great businesses probably gotten to valuation multiples that look relatively full here. So you're probably going to see a little bit more money rotating into different parts of the market.
You mentioned you were adding to some places yesterday. Where were you adding?
So financials, gold, selectively in the REIT space. I like all those sectors here. They all kind of have the same tailwinds here. If you believe that the U.S. dollar is going weaker and yields and interest rates are going to continue to go lower, financials should start to see a little bit better loan growth as you get into 2024. Materials in particular, the gold space. If the U.S. dollar continues to get weaker and yields do go lower, the gold space is going to do quite well. Gold prices broke out a couple of weeks ago. They've consolidated a little bit here, but the stocks have been a bit of a laggard to the overall gold price. Given that inflation continues to moderate as well, that should help the profit margins for those companies. And then, as you mentioned in the introduction, the REIT space has been hit very hard this year. They have a high level of sensitivity to the movement in interest rates, and so with rates going lower next year, I think you're going to see the valuation multiples for that part of the market expand, and you should start to see transaction volumes pick up there. And so all three of those parts of the market have been underperformers this year. I think you're going to see a catch-up trade in those as you move into 2024. Within
the REIT space, Mike, are there areas that you like more than others, or areas that you would stay away from still?
It's a pretty diverse space, right? So
Yeah.
I think you kind of have to pick your spots. So like, Colliers is a name that I own. First Service is another name that I own. Tricon's a name, you mentioned it, that I've owned in the past. Those are businesses that have a lot of torque, as I said, to a lower interest rate environment. So I think you want to be selective here, probably wade into these names, but maybe do it over the next one or two as they might settle out a little bit here.
Yeah, I was looking within real estate today, and I think Colliers, was one of the most influential gainers within the sector today. What do you like about Colliers?
Yeah, so this is a great long-term compounding name, which I've talked about a number of these on the show in the past. So a lot of exposure to commercial real estate. That's obviously been a bit of a challenge so far this year, but very disciplined management team here. So they have three verticals here. They have an advisory component to their business, which is really property management. That has a good stable earnings profile, not a lot of cyclicality, does well over all real estate cycles, and it's continued to do well despite the challenges of broader real estate in the last year. Investment management is a really high growth part of their business. So they're adding into infrastructure assets, other private alternative assets, very high margin business. They've been able to buy a lot of companies over the last year that as valuation multiples have come in for real estate companies. And then the last area, which probably will provide the upside over the next 18 months, is the leasing part of their business. So they do office and industrial property leasing, among other areas in real estate. That's been a very challenging market. As you know, transaction volumes have really dried up. Access to capital has been difficult for their customers. I think that's going to start to ease as we get into 2024, particularly as rate gets cut in both Canada and the U.S. And so you should start to see the margin profile of that business move back up. So if you look over the long term, this is one of the best performing stocks in the last 10 years in the Canadian marketplace. Really good management team. They have a really solid balance sheet. And I think as you get through, the next, as this cycle kind of matures, this is going to be a really good business for the next couple of years. And
Colliers is one that both you own and your firm own. Is that right, Mike?
That's correct, yes.
Okay. Mike, always great to get your thoughts. Thanks so much for joining us this afternoon.
Thanks for having me. Have a great day.
Thanks, you too. That was Mike Archbald, Vice President and Portfolio Manager at AGF Investments.
Welcome back. You're watching BNN Bloomberg's Newsmaker of the Year special. We have got through some of the runners-up of the top story of the year, but nothing comes close to this. The top story in the BNN Bloomberg newsroom, the Bank of Canada's rate hiking cycle. The central bank hiked rates 10 times between March of last year and July 2023, pushing them to a 22-year high of 5%. Now, Governor Tiff Macklem, in the last policy decision, gave few hints that the period of rate hikes may finally be over. Certainly, we know that's something that investors have been waiting for. But, aside from, and of course, we're going to take a look at what is in store when it comes to rate cuts next year. What a tremendous, unprecedented move that we saw in rates, and the Canadian economy, Paul, kind of holding. I mean, you break that data every month, the jobs data, the economic data.
I remember Derek saying last year at this gathering last year that 2022 was the year that rates increased in a big way. 2023, he predicted, would be the year that we all coped and adjusted and reacted to those higher rates. And I think that's largely come to pass. You don't have to go very far these days to find people who are worried about their mortgage renewals, the implications in the stock market, and of course the most recent signals are indications, certainly in the fixed income market, that 2024 will be the year that rates go down.
Economically, it was kind of like a year of two halves. I mean, the first half, the story was really the economy doing better than we all expected, not reacting as quickly as we thought to those higher interest rates. And the Canadian economy created almost 300,000 jobs in the first 6 months of the year. In the second half of the year so far, we're at half of that. And with further numbers still to come. So, and we've seen that too in the polling that we do on consumer sentiment every week with Nanos Research Group. It was actually relatively strong into the summer. You've seen it dip down as people, more mortgages reset. People start to worry more about the job situation.
Wouldn't you say, though, that's a feature, not a bug, of what the central bank has been doing? They're trying to do that.
Absolutely. I mean, this is so far, this has played out in a way that is more or less what they would have hoped, right? We've got unemployment higher, but not, so high that it's causing, significant pain. We have inflation coming down, and we have a loosening of other indicators, like there's not as many open jobs, and businesses aren't having to bid up wages so much. So, yes, I totally agree. So far, it is playing out the way that they would have hoped.
Yeah, it seemed interesting, too, about it wasn't just about the hikes, but it was about those pauses. So the first signaling of a pause to come and the influence that had on people, on Canadians, on prospective home buyers when we saw
February
the market,
when we got it, yeah.
When we saw the market pick back up again in the spring, and then to go a couple more times, 2 more hikes, and then pause again. It was just a different scenario at that time. It was a real chill that came from that one when you're thinking, especially with the housing market.
And now you got to look ahead to rate cuts, but not just rate cuts. Even with lowered rates, most Canadians are going to have to renew their mortgage over the next 2 to 3 years, because ours are done on a 5-year basis. And regardless of whether we get those cuts or not, it's going to be at a higher rate. I mean, that's going to squeeze Canadians, and I think we're still trying to figure out what's the impact of that going to be.
What you hear most often from economists and portfolio managers as well is that likely means less discretionary spending. That people have to spend on their mortgage, and many will have to cut back on what they spend on other things. And the concern is, what does that do to the Canadian economy?
We were talking with an economist from TD recently about this, and they were looking at the credit card data and mortgage data, and looking at people who had to renew in the past couple of years and how much they pulled back spending. $6 billion worth of spending pulled back by these people who had to renew mortgages in 2021, 2022, and 2023. So that, when you think about the increase in spending or decrease in spending yet to come from people who still need to renew mortgages, I mean, they're even pulling back in anticipation of needing to renew. So there's definitely less spending happening, especially in comparison to the U.S.
Well, that's a good point, because it's so far down the line that you can prepare for it. Canadians can prepare for it. I was speaking with the CEO of Desjardins, and said his people have made 75,000 calls, more than 70,000 calls to their people, the people that hold mortgages with them, to say, listen, you've got this issue. Let's manage through it now.
Mm-hmm. And Canadians do tend to be fairly, prudent about this stuff. One interesting, I think, surprise for me this year is, although the housing market has been slow, you would think that with rates going up so quickly, and not just the Bank of Canada rate, but at the longer end, they went up. The 5-year rate went up a lot. That perhaps prices would have corrected more, and really not. Really, the price reduction from the peaks still pretty modest.
You're right, and Canadians do love their housing, and of course, supply demand can often trump all of that. Team, thank you so much for this chat. It was so great to reminisce with you about the top stories of 2023. I'm looking forward to what 2024 has in store. Thank you so much for tuning in to our Newsmaker of the Year special. Happy holidays.